We want to bring in former Atlanta Fed President Dennis Lockhart. He's now a professor with Georgia Tech. And Dennis, thank you very much for joining us this morning. I think this is kind of a situation a lot of us who have been watching for a long time are a little confused about. And this comes with Chairman Powell's description last week at the news conference. He started out talking about how great this economy is, how strong the jobs market is, but then the explanation for why cutting 50 basis points at this moment. We're still trying to get our head around it. If things are great, why cut aggressively? And how much more should we expect? What's your explanation from somebody who's been in the room?
I think they've shifted from fighting inflation and being a little bit nervous about the employment situation to really protective mode. I think if we saw the status quo, both growth, employment, and inflation just persist for some period of time, they would be pretty happy with that picture. So I think it was Austin Goolsbee who used the word demarcation. This is a point of demarcation from a phase that had a different emphasis to the phase today that has the emphasis on protecting and preserving what they've got. And the 50 basis point move, I think, was maybe just a little bit of a catch-up from July. Jay Powell said in the press conference that he could have moved in July had he known the data incoming just after the meeting. And so there may be a little bit of catch-up and sort of a down payment for the beginning of this protective mode.
Jamie Dimon is always pretty cautious. It's his business line as a banker. But does he have a point in just thinking that maybe the markets are priced to perfection and his odds of that perfection happening are a little less than what he's seeing reflected in those markets?
Yes, I would never totally second guess Jamie Dimon because he's very astute when observing all these things. So I think what he may be reflecting is that there are sort of rose-colored glasses on markets today. They have bought into the idea that there will be a soft landing. The soft landing is underway, so a fair amount of it has already been achieved. And that can set you up for disappointment if there's a development of one thing or another that throws the economy off. So I think it is perhaps a judicious posture just to say, look, things look awfully good now, but they could actually go south from us.
Maybe that's fair. Rose-colored glasses could be thinking everything's going to be well. It could also be thinking that there's a Fed put that's back in play, and if the markets go down, the Fed will react aggressively. How do you think the Fed is looking at this? What do you think is going to happen, let's say, the rest of this year and into the first half of next year?
Well, I will take the Fed speak of yesterday as a good indication, particularly Neil Kashkari's comment of basically two more 25 basis point moves. I think it's likely we're on a fairly deliberate and steady 25 basis point cut series for the next several meetings. If you look at 2025, the median in the dots is, I think, for about 7 total cuts from where we are today. That suggests not every meeting next year, but several meetings next year. And I think that's a base case. It's always a base case. They really don't know because it truly is meeting by meeting, and they will make a decision based on the incoming data. But as an outlook from today, I'd say 6 or 7 more cuts of 25 basis points. I don't completely dismiss the idea that they'll go heavy in the beginning and maybe put in another 50 basis point move. That could very much be simply the preference of the core group of the triumvirate that are at the core of the committee, if they decide that that's the way they want to unfold this rate-cutting regime.